As organizations strive to optimize their operations and enhance profitability, the effective use of standard costing has become increasingly crucial. Standard costing, a management accounting technique that assigns predetermined costs to products or services, can provide valuable insights into a company's cost structure and drive continuous improvement. However, to truly harness the power of standard costing, it is essential to establish a comprehensive set of metrics and key performance indicators to measure its impact on business performance. In this article, we will explore the key metrics and KPIs that organizations should consider when evaluating the effectiveness of their standard costing systems. By closely monitoring these indicators, companies can gain a deeper understanding of the true cost of doing business, identify areas for improvement, and make more informed strategic decisions. Cost variance analysis. At the heart of any standard costing system is the ability to analyze cost variances, the differences between actual costs and the predetermined standard costs. By closely monitoring these variances, organizations can identify operational inefficiencies, detect changes in market conditions, and take corrective action to improve their financial performance. The primary cost variances to track include material price variance, the difference between the standard price and the actual price of materials. Material quantity variance, the difference between the standard quantity of materials expected to be used and the actual quantity used. Labor rate variance, the difference between the standard labor rate and the actual rate paid. Labor efficiency variance, the difference between the standard hours expected and the actual hours worked. Overhead variance, the difference between estimated overhead costs and actual overhead costs. By analyzing these variances, organizations can identify the root causes of cost discrepancies and implement targeted solutions to address them. For example, an unfavorable material price variance may indicate the need to renegotiate supplier contracts or explore alternative sourcing options, while an unfavorable labor efficiency variance could prompt process improvements or workforce training initiatives. Imagine a furniture manufacturer that notices a significant unfavorable material price variance. Upon further investigation, the company discovers that the price of a key raw material, wood, has increased due to a supply chain disruption. Armed with this information, the company can work with its procurement team to find alternative suppliers or negotiate better terms with the existing vendor, ultimately reducing the material cost variance and improving overall profitability. Gross margin analysis. Another critical metric for evaluating the effectiveness of standard costing is gross margin analysis. By calculating the gross margin for each product or service, organizations can assess the profitability of their offerings and make informed decisions about pricing, product mix, and resource allocation. The gross margin can be calculated as follows. Gross margin equals revenue, cost of goods sold. COGS, in this case, should be based on the standard costing system, as it provides a more accurate and consistent representation of the true cost of production. By tracking gross margins over time and across different product lines or business units, organizations can identify the most profitable areas of their business and focus their resources accordingly. For instance, a manufacturing company may discover that its high-end product line has a significantly higher gross margin compared to its lower-end offerings. This insight could then inform the company's strategic decision, such as investing more resources in the production and marketing of the high-margin product or exploring ways to improve the profitability of the lower-margin lines. Imagine a consumer electronics company that produces both premium and budget-friendly product lines. By analyzing the gross margins for each line, the company may find that its premium products enjoy significantly higher profitability. This could lead the company to shift its focus and marketing efforts towards the premium line, while also exploring ways to streamline the production of the lower margin budget products to improve their overall contribution to the company's bottom line. Inventory turnover. Inventory turnover is another important metric that can be influenced by the effectiveness of a company's standard costing system. Inventory turnover measures the number of times a company's inventory is sold and replaced over a given period, and it is calculated as inventory turnover equals cost of goods sold, average inventory. By accurately tracking the standard costs associated with each item in the inventory, organizations can better manage their stock levels, minimize obsolescence, and ensure that their capital is not tied up in slow-moving or unprofitable products. A high inventory turnover ratio may indicate efficient inventory management, while a low ratio could signal issues such as overproduction, inefficient purchasing, or product obsolescence. By monitoring inventory turnover and investigating the underlying drivers, companies can optimize their working capital and improve their overall financial performance. Consider a case where a clothing retailer uses standard costing to track the cost of its inventory. By closely monitoring the inventory turnover for different product categories, the retailer may discover that its basic t-shirt line has a much higher turnover rate compared to its seasonal fashion items. Armed with this information, The retailer can adjust its purchasing and production strategies to ensure that more capital is allocated to the high turnover t-shirt line, while managing the inventory of the slower moving fashion items more carefully to minimize the risk of obsolescence. Return on investment. The ultimate measure of the effectiveness of a standard costing system is its impact on the organization's overall financial performance and return on investment. By tracking key financial metrics, such as net income, return on assets, and return on equity, companies can assess the broader impact of their standard costing initiatives on profitability and shareholder value. For example, if a company's implementation of a standard costing system leads to a significant reduction in material costs or improved labor efficiency, this should be reflected in an increase in net income and consequently a higher ROA and ROE. By monitoring these metrics over time, organizations can quantify the tangible benefits of their standard costing efforts and make a compelling business case for continued investment and improvement. Imagine a manufacturing company that has successfully implemented a standard costing system. Over the course of the following year, the company notices a significant increase in its net income, as well as an improvement in its ROA and ROE. Further analysis reveals that these improvements are directly attributable to the cost saving and operational efficiencies gained through the standard costing initiative. Armed with this data, the company's finance team can make a strong case to the executive leadership for continued investment in the standard costing system, as it has clearly demonstrated its ability to drive tangible financial benefits for the organization. Key performance indicators for continuous improvement. To drive ongoing improvements in standard costing effectiveness, organizations should also establish a set of key performance indicators that can be monitored and adjusted on a regular basis. These KPIs should be closely aligned with the organization's strategic objectives and focus on areas such as cost management, operational efficiency, and financial performance. Some examples of KPIs that can be used to track the effectiveness of standard costing include standard cost accuracy, the percentage difference between standard cost and actual cost, with a target of minimizing the variance. Variance analysis timeliness, the time taken to identify and investigate cost variances, with a goal of reducing the response time. Process improvement rate, the number of process improvements implemented as a result of standard costing variance analysis, with the aim of increasing the rate of improvement. Standard cost-based pricing accuracy, the percentage difference between prices set using standard costing and actual market-based prices, with a target of maximizing pricing accuracy. Standard cost-based budgeting accuracy, the percentage difference between budgeted cost and actual cost, with the goal of improving the reliability of budgeting and forecasting. By regularly monitoring these KPIs and making data-driven adjustments to the standard costing system, organizations can foster a culture of continuous improvement and ensure that their costing practices remain aligned with their broader strategic and operational objectives. Imagine a food processing company that has implemented a robust standard costing system. The company's finance team closely tracks the standard cost accuracy KPI with a target of maintaining a variance of less than 5% between standard and actual costs. Each month, the team reviews the variance analysis and works closely with the operations team to identify the root causes of any significant discrepancies. This collaborative effort has enabled the company to make continuous improvements to its production processes, ultimately enhancing its overall cost efficiency and profitability. Implementing an effective standard costing measurement framework. To ensure the successful implementation and ongoing effectiveness of a standard costing measurement framework, organizations should consider the following best practices. Align KPIs with strategic objectives. Ensure that the selected metrics and KPIs are closely tied to the organization's overall strategic goals and priorities. This will help to ensure that the standard costing system is supporting the broader business objectives. Establish clear roles and responsibilities. Clearly define the roles and responsibilities of the various stakeholders involved in the standard costing process, from data collection and analysis to variance investigation and process improvement. Invest in robust data capture and reporting. Implement systems and processes that enable the accurate and timely capture of cost data, as well as the generation of comprehensive reports and dashboards to support decision making. Foster a culture of continuous improvement. Encourage a mindset of continuous improvement among the organization, where every variance is seen as an opportunity to enhance efficiency and reduce costs. Provide ongoing training and support. Ensure that employees at all levels, from the accounting team to the production floor, are equipped with the necessary skills and knowledge to understand and effectively use the standard costing system. Regularly review and refine the measurement framework. Constantly review the effectiveness of the standard costing measurement framework and make adjustments as needed to ensure that it continues to provide value and support the organization's evolving needs. By implementing a comprehensive and well-designed standard costing measurement framework, organizations can unlock the true potential of their standard costing systems, driving tangible improvements in operational efficiency, financial performance, and strategic decision-making. Conclusion: evaluating the effectiveness of a standard costing system is essential for organizations seeking to optimize their operation, enhance profitability, and make informed strategic decisions. By establishing a comprehensive set of metrics and KPIs, companies can gain a deeper understanding of their cost structure, identify areas for improvement, and drive continuous enhancements to their standard costing practices. From cost variance analysis and gross margin monitoring to inventory turnover and ROI tracking, the metrics discussed in this article provide a robust framework for assessing the impact of standard costing on business performance. By incorporating these measures into their management practices and aligning them with key strategic objectives, organizations can unlock the full potential of their standard costing systems and position themselves for long-term success in a rapidly evolving business landscape. As companies navigate the challenges of the modern business environment, the ability to effectively leverage standard costing and its associated metrics will become increasingly crucial. By mastering this technique and continuously refining their measurement frameworks, organizations can enhance their operational efficiency, improve their financial performance, and make more informed strategic decisions that drive sustainable growth and profitability.